Hello, and welcome everybody to today's annual tax planning webinar. My name is Patrick Crosby. I'm a supervisor here at GRF CPAs Advisors, and I will be the moderator for today's session. I'd like to start off with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically following the webinar. You will be asked to recall 3 CPE words in order to receive credit. Please write down the CPE words when they are given and hold on to them until you receive your certificate, as they will not be provided again. If you have any technical questions or issues during the discussion, please use the chat function to speak with our administrator for assistance. The slide deck and recording from today's discussion will be available on the event page on our website. Technical support and CPE questions may be addressed to Nathan McKelveen at nmckelveen@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of how you should position your assets for the best tax advantage. I will now introduce our speakers for today's webinar. Troy Turner has worked in the tax area of public accounting since 1997 and has a broad range of tax consulting experience. As director, he oversees the firm's tax department and specializes in providing tax advisory and compliance services for both businesses and individuals who have international aspects to their tax situations. Stephen Boisvert is a senior manager in the tax department at GRF. He joined the firm in 2008. As a senior manager, Stephen reviews and supervises the preparation of individual, corporate, partnership, LLC, and trust tax returns. And now I will turn the presentation over to our speakers.
Thanks, Patrick, for the introduction, and welcome to our 2021 tax webinar. This is our agenda for the day, and we'll start with some individual tax topics that we felt would be helpful to call out as useful tax planning tools. And then Troy will take us into a discussion of issues pertaining to businesses and business owners. We'll finish our talk today about potential changes from the Build Back Better Act, if it is passed in its current state, just with the added disclaimer that these issues are still being debated in Congress. Just wanted to start with, these are the new tax brackets for the 2021 tax year. They have been adjusted for inflation, so there have been some slight increases across the board. These are marginal tax brackets. So if your income falls in the marginal bracket, that bracket is your top tax rate. The actual tax rate on your income, though, is the average tax rate, and that is spread out across all the brackets that your income covered. So just for a quick example, if your income is like $150,000 a year and you're married filing joint, your first $19,900 will be taxed at 10%. The income from $19,901 to $81,050 would be taxed at 12%, and the income from $81,051 to $150,000 would be taxed at 22%. So don't be concerned about tripping into a new bracket. Some people always are concerned, hey, yeah, I got into the 22% tax brackets. No, my income is going to be taxed at 22%. That's not how it works. It's an average of the brackets that you went through. So one other item I wanted to call out in this particular slide is you can see the marriage penalty is still in full effect once you hit 35% tax bracket. From 10 to 32%, if you look in that first column, the single bracket, all of those amounts are 50% of the married filing joint bracket. But once you get into the single taxpayers 35% bracket, they're in that bracket for a much longer period of time than is the married filing joint. And you can see the married filing joint returns will hit the 37% rate much faster than a single. I want to note the standard deduction has also been adjusted for inflation for 2021. So each of these ticked up slightly from 2020. The interplay you're always trying to figure out, though, is regarding the standard versus the itemized deduction. So how much of the itemized deductions do you think you'll have at tax time? And will I be able to itemize when I file my tax return? Those are the kinds of questions you're typically asking yourself when it comes to dealing with this particular deduction. Depending on how close you are to the standard deduction, there are some strategies that you can employ to optimize your deductions over a couple of tax years. But before we get into some of those strategies, I just want to take a minute to remind you of the itemized deductions that you do have at your disposal in 2021. And that'll be on the next slide here. So starting with medical deductions, if you look at like Schedule A from your tax return, I'll just go right down the board, just the way that the Schedule A would show up. Medical expenses are still in the itemized deduction category. They are subject to a 7.5% AGI floor, adjusted gross income floor. What does that mean? It just means that if your medical expenses are in excess of 7.5% of your AGI, you get to deduct some. So for a quick example, say your AGI is $100,000, you would need $7,501 of medical expenses to deduct $1. State and local taxes include your real estate taxes and your property taxes. To date, these are still capped at $10,000 for 2021. Troy will probably discuss a little bit of the SALT deduction, state and local tax deduction, SALT for short. You probably heard about it in the news a little bit. There are some potential changes that are being debated in Congress right now, but for our purposes at the current date, that is still capped at $10,000. So if you had 80 or say $100,000 of state and local taxes, the cap is still $10,000 is how much you're allowed to deduct from those. Mortgage interest is typically one of your larger itemized deductions, and often the most influential in determining whether a taxpayer can itemize or not. Mortgages that were originated before December 15th, 2017 are still capped at $1 million. Whereas mortgages that are after that December 15th, 2017 date are capped at $750,000. I'm not going to go into exactly what that means, but if you have questions about how much of your mortgage interest you can deduct, feel free to reach out to us. We can explain how that works. Then, of course, if you have a home equity line of credit, they are deductible if used for buying, building, or fixing up your residence, the taxpayer's residence. The last thing that you can take as an itemized deduction is charitable contributions. And charitable contributions are the one true discretionary itemized deduction that you have. Mortgages, taxes, medical are often things that you have to pay, and you don't really have much say about whether these are paid or when they are paid. The mortgage has to be paid each month. The taxes have to be paid by the current year deadlines, or you're subject to penalties and interest. With the exception of elective surgery, most of the time your medical deductions occur whether you like it or not. Charitable giving is different in that you have a choice. You really have two choices. First is whether you make a charitable contribution in the first place, and the second is when you make the charitable contribution. And this kind of takes us back to what we were discussing on the previous slide, which is how do we optimize our standard and itemized deductions? So if you're just under the itemized deduction threshold and you plan to give to charity, you may want to consider making 2 or 3 years of charitable contributions at the end of the taxable year, where you're just on the threshold of being able to itemize. And then the next year or two, you don't make a charitable contribution because you made it in, say, 2021. But then you would take the standard deduction for that. It's called bunching your charitable contributions, and it can optimize the best way to use both deductions on your taxes. So here in slide 10 here, sticking with the theme of charitable contributions, we wanted to run through a quick example of why it's so beneficial to contribute appreciated stock as opposed to selling the stock and then contributing the proceeds. So if you contribute to various charities every year, you may want to consider contributing stock rather than cash. And in our example here, we're going to say that the AGI of our taxpayer is $700,000, and this includes a $50,000 gain from Apple stock. The way we got to our $50,000 gain was that the stock has a fair market value of $100,000 at the date we plan to sell it, and we purchased the stock for $50,000. So we have a fair market value of, or we have a capital gain of $50,000. We're going to say it was held for, long-term, held for more than a year. So we're going to get the preferential tax, long-term capital gain tax rate of 20%. And we're going to say our taxpayer is married and filing joint. If you cash out the stock and pay tax on it because you cashed the stock out before contributing it, you would be subject to the 20% capital gains stock or capital gains tax and the net investment income tax of 3.8%. So that $50,000 gain would receive a tax of $11,900. And then if the taxpayer determines they want to contribute the $100,000 to charity with the ordinary income that they've already paid the tax on, they would be getting a 37% deduction. If you can go to the next slide, we'll see what the difference is here. So instead, let's say we don't cash out the stock and then contribute $100,000. We're just going to contribute the stock itself, the Apple stock, to our charity, whatever charity of choice, say Salvation Army. So because we're going to contribute the stock and not cash it out, our AGI is now going to be $650,000 because we don't have that $50,000 gain to include. Contributed capital gains do have a 30% AGI limitation, which basically just means that as long as your charitable contribution is under, in this case, $195,000, none of it will be limited. But by contributing the $100,000 to charity, you reduce your taxable income to $550,000, and you avoid the recognition of the gain on the sale of the Apple stock. So just by not cashing out the stock and just contributing the stock directly to the charity, your tax is $14,775 less in this example. So it would be a big mistake to cash out the Apple stock, then contribute it to charity, as opposed to just contributing the stock to charity directly. If you're interested in capital gain tax planning options, just get in touch with us. This could be an area with very valuable tax planning. If you want us to run scenarios on that, let us know, and we'd be happy to do that. All right, moving on. It's changing gears just a little bit. Just other ways to reduce your taxes. You can use your year-end bonus to max out your 401k. 401k and 403b contributions are pre-tax, so it's just going to come straight off your wages. You're not going to pay tax on it until you make distributions from your retirement account. That's an easy way to do it. Hold investments for more than a year before selling. You get the long-term capital gain treatment. And Troy, I think, will talk a little bit about this at the end when he discusses some potential changes to long-term capital gains. So stay tuned for that. You can sell investments at a loss to offset capital gains. You'll hear sometimes your investment advisors say, hey, we can harvest some losses. This is normally stocks that you haven't performed so well, but if you have other stocks that have performed well, you can sell some of those stocks off to mitigate some of the gains that you're going to recognize. As we talked about earlier, accelerating medical expenses just to get over that 7.5% threshold. Maybe there's some elective surgery that you're thinking about taking, provided the hospital will allow you to take it with the COVID stuff going on. Contributing to your IRA, it's going to be deductible in some circumstances. If it's non-deductible, then you're going to have basis that you can offset some of the tax in the future. And then don't miss out on common tax credits like the child tax credit, child care and education credits. On our next slide, this is something we wanted to give just a little warning about. It could be very beneficial. For some, you may have to pay some of it back. So it's called the advanced child tax credit. If you are receiving monthly payouts for the advanced child tax credit, beware that you may need to pay all of it, or all or a portion of it back. And it's just so you can kind of understand how this works, we'll talk about the old rule and talk about the new rule. So the old rule provided child tax credits of up to $2,000 per child under age 17. So I've got 4 kids. I get an $8,000 tax credit for my 4 kids. I receive this credit on my tax return, and it's always phased out when AGI levels exceed $400,000 on joint returns and $200,000 for all other returns. Now, the new rule is more beneficial. You get $3,000 per kid under 18, and you get $3,600 for children under 6 at 12/31/2021. However, that additional $1,000 credit from the 2,000 to 3,000, it phases out at 150,000 on joint returns. It's 75,000 on single returns, back down to the $2,000 credit. As I'm throwing a lot of dollars and cents at you here, but basically the 2,000 phases out as before. So you've got kind of a 2-tiered phase out. You've got the $150,000 phase out for the additional $1,000 tax credit from 2,000 to 3,000. Then you got a $400,000 phase out for the original $2,000 credit. To add to the complexity of this, 50% of the credit was required to be paid out in advance payments in 6 monthly installments beginning on July 1st, unless you opted out. In my case, I opted out. Some people didn't opt out, so you've been receiving a check from the government each month, and the calculation was based on your 2020 AGI level. The kicker is that this credit will be reconciled on your 2021 tax return. So if you go to the next slide, this is where the warning comes in. So there's 2 potential traps. First, if you did not opt out of the advance payments, then you should expect your child tax credit claimed on your tax return to be half of what it would have been previously, because half of it was already paid out to you in advance payments. So say we use an example, if your AGI in 2020 was $145,000 and you're married filing joint and have 2 kids over 6 and under 18, your child tax credit for 2021 is $6,000. If you didn't opt out of advance payments on your tax return, you will get $3,000 advance payout split out over 6 months. And then $3,000 will be paid out on your tax return. The bottom line here, though, is that last year you would have gotten a tax credit of $4,000 for your 2 kids. This year, you got a $3,000 payout throughout the year, and your child tax credit will be $3,000 in this scenario. So you may see less tax credit on your tax return, which could, in my case, I use a lot of my child tax credit to mitigate the remaining tax liability I have. So just something to be aware of. The second thing to be thinking about is if you take our example for 2021, your AGI is $155,000, so it's increased $10,000. You'll have to pay back a portion of the additional tax credit received. So that additional $1,000 per kid, $2,000 for the 2 kids in our example, some of that would have to be paid back through the tax return. So it's great if you're under $150,000. If you go over $150,000 in our example in 2021, you may need to pay a little bit of that back. If you're concerned about this and you want us to run a scenario for you, we can talk through that. I think the last topic that I was going to cover was virtual currencies. This is kind of a hot topic with the IRS right now. Just want to give you some pointers on how the IRS treats virtual currencies. So they are treated as a capital asset, just like if you were holding Apple stock or whatever. On the tax return, there is a line where you have to disclose if you've traded in virtual currencies in the current year. So you have to say yes or no, I bought, sold, received, or transferred virtual currencies. Typically, we only report things when they're sold, but for virtual currencies, they want you to tell them, yes, I have done this, even if it's just a purchase or you've received it somehow. Because the value of virtual currencies is constantly changing, if you held a currency at any time during the year, you most likely have a gain or a loss. And thankfully, some of these exchanges where you can get them, like a Coinbase or Robinhood, or different virtual currency exchanges now, they are getting better and better at tracking the basis. But if you transfer currencies from, say, Coinbase to Binance, different trading platforms, you have to do the work yourself to basically say, what is the basis of these coins that I'm trading in? And I would say the most important thing you can do is, when you make a sale or a transfer, make the conversion immediately to US dollars, just to make sure that you have some record of what it was. We can talk more about virtual currencies at another time, but I just wanted to call those out to you.
We've come to our first polling question. Which statement best describes where you currently stand with your 2021 tax planning? A, I have already done my planning for 2021. B, I am interested in planning, but I have not begun the process. C, I do not plan on doing any planning this year. Please take a moment now to answer, and while participants are submitting their answers, I will provide the first CPE word. The first CPE word is currency. If you wish to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is currency.
Thank you, Steve, for providing all that great, useful information. Welcome, everybody, to our webinar this morning. As Patrick mentioned, my name is Troy Turner. I'm going to be covering some of the business provisions and some of the potential law changes that could be coming for all of us through the House bill that was recently passed. Again, there's a lot of work left to be done on that, but we'll touch on those things that could potentially happen at the end. But first, the first topic I wanted to cover is one that isn't new. This is something that came into law in 2018, the qualified business income deduction. So there haven't been any changes to this for tax year 2021, but it's a very valuable and a very important deduction that you can qualify for on your individual tax return if you have qualified business income. So what is qualified business income? It's generally income from a sole proprietorship, so income you report on Schedule C. It could come from a partnership, LLC, S Corp, rental property that you have. Keep in mind that if you do get your qualified business income from a K-1, that the person preparing the K-1 must provide all the required information for you to be able to take the deduction on your personal return. So we haven't run into too much issue with the information being missing. So I think all preparers are keyed into this, but that information is on the K-1 that we would then turn around and utilize on your personal return to make sure that you're getting this deduction if you qualified for it. So the deduction itself is basically 20% of your qualified business income amount, or 20% of your taxable income after removing capital gains, whichever amount ends up being lower. And then once you figured out that amount, it can be further reduced or eliminated depending on whether or not you're a specified service business, or whether or not your business has significant wage expenses or significant tangible depreciable assets as well. So if you're a specified service, first, I guess I should say, irregardless of those things, if your income on a single return or a return other than joint is below the income threshold of $164,900, And in a joint return, 329,800. So if you're below those two thresholds, you don't have to worry about what kind of business you are and what kind of wage expenses you have, or at what level or anything else. You can qualify. If you have qualified business income, you can qualify for the full deduction as calculated. If you're a specified service business, then you lose the ability to take the deduction once your income's above 429,800 on the joint return and 214,900 on anything other than a joint return. And if you're not a specified service business, then we need, and your income is above these limits or within the phase out ranges, then we need to look to see whether or not that business has reportable wages or paid to employees or assets, and then that can provide a further limitation. So for example, if your QBI qualified business income happens to be 100,000, in order to take that deduction, assuming you're above the limits, you need to have $200,000 of wages, so that 50% of that would be 100, so that you could take the full QBI deduction on your return. So, so there's some complexities here, and we're happy to work through some planning on this discussion. If you have qualified business income on your return, and we can see, whether you're subject to the phase outs and what the overall result is, just reach out to us. I also have listed an FAQ that the IRS has on their website that provides some more detailed information. So we got a slide here that covers what is a specified service business. A lot of the clients in our DC metro area fall into this category, but generally it's professional services, performing arts, athletics, and then also consulting. So that's kind of the big catch-all that we find that affects a lot of our clients. There's a definition that I won't read to you that's on the bottom of the slide, what the IRS says consulting is. But if you feel like that might affect you, reach out and we can analyze that and see if you fall into the consulting category. Some other considerations on the qualified business income deduction. So if you're getting your income primarily from an S corp that you work in, then shareholder compensation comes into play here. So this has always been an issue, generally in the reasonable comp discussion. As a shareholder in an S corp who's working in the business is required to take reasonable compensation. Normally, we would say that the lower the reasonable comp, the better, because the net income that flows out of your S corp is not subject to Social Security Medicare taxes, otherwise called self-employment tax. So there's savings there. But the income that comes out of your S corp also qualifies for the qualified business income deduction. So there's an interplay between how much reasonable comp you take, and because the more comp you report, the lower your QBI deduction is, but you need to take something that's considered reasonable. So anyway, just understand there is some interplay with S corp comp and the QBI, and we can help with that as well. Guaranteed payments from a LLC or a partnership are not QBI. So it's important to know if that's how you're getting income out of your LLC or partnership is via guaranteed payments, that's not factored into the deduction calculation. So in that case, it's better to get a profits allocation, an income allocation, than a guaranteed payment as a way of receiving your income from an LLC or partnership. So if you're doing guaranteed payments and you can qualify for the QBI deduction, then you may want to think about revising your agreement to change that, because it could provide some good tax benefits for you. REIT dividends and publicly traded partnership income is QBI. It's important to point out that qualified business income doesn't include foreign income. QBI is also calculated on a per business basis. So that calculation we talked about on a previous slide relative to the wage limitations and asset limitations and things like that, and specified service. You have to do all of that first and come up with whatever your QBI amount is per business, and then you aggregate those and see if you have overall QBI income or a loss. And if you have a loss, that loss carries over and factors into your calculation the following year.
We've come to our second polling question. Has the qualified business income deduction been a significant benefit to you? A, yes, I've claimed a substantial deduction since 2018. B, no, I do not have any qualified business income on my return. C, not yet, but hopefully it will be this year. Please take a moment now to answer. While participants are submitting their answers, I will provide the second CPE word. The second CPE word is deduction. If you wish to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word is deduction.
Okay, thank you everybody for participating in the poll. Looks like we have about 18% have already claimed the deduction. It's been a great benefit. A significant portion of you don't have any QBI. And then we have a segment about the same as the first one that hopes to have it this year. So for those folks, please reach out if you'd like any help figuring out what your potential QBI deduction would be relative to your tax planning. Another big area for tax savings is in the bonus depreciation in Section 179 deduction area. There haven't been any changes in this in 2021 relative to what you could do in 2020, except for the 179 deduction does get increased slightly each year. So for 2021, the amount you can actually write off of new property purchased, new or used property purchased is $1,050,000, and that you can deduct that full amount, as long as you don't buy $2.6 million worth of property. So not many of our clients hit these limits. And it's important to point out that if you do utilize the Section 179 deduction, you can't use it to create a loss. So you could utilize it to write off new equipment or used equipment that's been purchased in 2021 to get your business income to zero, and then any additional 179 that isn't taken carries over the following year. Bonus depreciation works in a similar manner. It's currently 100%, so it's a full write-off, but it can create a loss. So often we would use bonus depreciation over 179 for that purpose. And it's also important in both of these to look to see how the state handles each one of these, because it could be different in deciding which way to go, whether you use bonus or Section 179. But in general, just looking to buy new equipment if you're going to buy it anyway in the coming months, buying it before year end and utilizing these provisions can provide significant tax savings. So the 461L loss limitation rules, these were new in 2018, and then COVID hit, and then the CARES Act suspended these limitations for tax years 2018 through 2020. So now we get them back, or I guess we get them for the first time in 2021. So this law, again, that was actually put into place initially for 2018 is now coming into play in reality in 2021. If you did limit yourself in 18 or 19 before the law came out, you'd be required to go back and amend a return to do that if you haven't done so. But basically what this is if you have an aggregate of business losses on your individual return from, say, Schedule C and K1s from S Corps partnerships, and you've already met the other criteria that are listed here, the first three, you have basis, you're at risk for the loss, and you meet the passive activity rules limitations. So the loss is allowed generally because it's an active loss, not a passive loss. So you've already gone through those three hurdles that were already in place prior to this law coming in. So you met that criteria. Now you have, say, $1 million loss from all of your businesses on your return. This will now limit that loss to $524,000 on a joint return and $262,000 on all other returns. So you could only take, the $524 on a joint return of the $1 million against your other income. and then their balance gets carried over and factored into the same type of calculation on your future returns. I wanted to touch on the employee retention credit. I think this has been in the news a lot. This was something that came into being in 2020 with the CARES Act. And it's a significant benefit. I think a lot of our clients have utilized this. Our outsourced accounting team actually has helped a lot of clients with this. So if once we get through these slides, if you feel like this might apply to you and you haven't utilized it, please reach out and we can provide some additional assistance. I'm just going to touch on the basics here. So again, back in 2020, when the CARES Act came out, it put this into place. The employee retention credit is a credit against payroll taxes, and it's based on qualified wages paid by an eligible employer. An eligible employer must meet one of two criteria, must either be meet the business suspension condition or a gross receipts condition. So the initial rule that was in effect from March of 2020 through the end of 2020 provided up to a $5,000 credit based on 50% of wages paid to an employee of $10,000 or more during the year. So it's an annual limit of $5,000 per employee paid based on $10,000 of wages paid between March and December. And then in order to qualify for that, you had to, again, meet the business suspension condition, which is generally a government mandated either closure of your business or reduction, mandatory reduction in the way your business operated. Again, reach out if you want the specific definition. We can help you work through that if that's something you think might apply to you. Otherwise, the other condition, the gross receipts condition, is more straightforward. If you had a 50% reduction in your gross income from the business in the current quarter of 2020, that would apply. So post March 13 through December 30. So say second, third, and fourth quarters. If you had a 50% reduction in gross income compared to that same quarter in 2019, then you met the gross receipts condition requirement. And then that phased out, as your income reduction through the quarters of 2020 got, if it wasn't 50, but say I had a 40% reduction, 30% reduction. So you were increasing your income relative to 2019, you eventually would phase out of the credit, the ability to take the credit if you got above a 20% reduction, or below a 20% reduction. So then in 2021, we had two different laws that were passed in early 2021 on the next slide. And the first one, the Consolidated Appropriations Act, extended the employee retention credit through the first two quarters of 21, and also increased the amount from $5,000 in total on an annual basis to $7,000 per employee per quarter. So it's 70% of up to $10,000 in wages paid per quarter. And then the ARPA Act was passed, and it extended the credit all the way through the end of the year, based on the same criteria or qualifications as before under the Consolidated Appropriations Act. So it's just an extension of that. And then just most recently, within the last month, we had the Infrastructure Investment and Jobs Act come out, and it curtailed this extension of the ERC. So it doesn't go through the end of the year now. It stops on September 30th of 2021. So basically from January 1 through September 30, 2021, businesses can still qualify for this $7,000 per employee per quarter credit against their payroll taxes if they meet either the business suspension or gross receipts condition requirements. And the gross receipts condition requirements for 21 is not a 50% reduction, it's just a 20% reduction based, of the 2021 revenue compared to 2019's or 2020's of the same quarter. So again, there's other nuances here on employer size and other details, but that's the basics of it. And we certainly wouldn't want you to miss out on it. So reach out if you have other questions on the ERC. So the pass-through entity tax credit, or not tax credit, but the pass-through entity tax came into play for the most part in 2018, or started to come into play in 2018. This is Steve had mentioned the SALT limit on your itemized deductions earlier in the presentation, were for 2021 and basically from 2018 through 2021. Your total state local tax deduction is capped at $10,000 as an itemized deduction on your return. So states in high tax jurisdictions began to pass laws that basically allowed the taxation, instead of happening at the individual level for a pass-through entity. So for an S corp or a partnership or LLC, normally those pass-through entities would flow the income to your personal return. You pay tax there, and then you get your tax deduction on Schedule A for your state income taxes. But what these various high tax states did is they created an entity level tax for pass-through entities, so that the tax would be considered a business deduction at the entity level, and therefore circumvent the Schedule A limitation. So the business would pay the tax on behalf of the members or the shareholders of the business, and take the deduction, and therefore the income amount on your K-1 that flows to you would already have that state income tax deduction in it, and you get the full benefit of it. So it was a workaround for that. We're adding it to our presentation this year because Maryland came out with their own provision for tax year 2020, and they worked through, it wasn't until mid-21 really that they kind of ironed out all the wrinkles of it, but it really was effective for tax year 2020. It's an annual election to take advantage of this entity level tax, and it applies to the Maryland sourced income on the pass-through entity return, and you pay the tax for both resident and non-resident members or shareholders. And then that tax is taken as a credit on the individual's personal tax return, whether they're filing a non-resident return or a resident return. And the election is made by just simply filing a Form 511, which is a new form for a pass-through entity, versus the Form 510, which is the old pass-through entity form that still is relevant if you aren't making the election. So new for 21, New York has come out with a similar provision to Maryland's. So a couple of differences here, and I'm highlighting New York because our firm does have a small presence in New York, and we have a lot of clients that have income out of New York and file taxes there. So we did want to point out that New York does have a provision that is new for 21 under the pass-through entity tax. So it acts in the same way as Maryland, and it becomes an entity level tax where the tax is paid at the entity level, the deduction is taken there, and then the credits that are paid for the pass-through members or shareholders are taken on their resident or non-resident returns. So this functionality is the same. What's different are the rates are different in New York. The rates are between 6.85% all the way up to 10.9%, although most people will probably pay that lower rate because that's lower rates effective on the first 2 million of income for the business entity, that is net income. The Maryland's rate was 8%. Another significant difference with New York is that for Maryland, you would make the election by simply filing the return, by the due date, the extended due date in the following year. For New York, you have to make the election during the year that you want the election to be effective. So you have between January 1 and March 15th of the current tax year, you want to have the entity tax election in effect. So for 21, it's too late. So when they passed the provision mid-year, they allowed some extra time through October 15th, I think it was, for people to make the election for 21. So it's too late for 21. But if this sounds beneficial to you, you need to make the election, starting January of 22, which is obviously coming up. So you'd have some time there to do that. Again, we can run some numbers for you if you like. There's other states that have similar provisions that we do deal with, but not nearly as much as obviously Maryland and New York. And just kind of as an aside, DC doesn't need to have a pass-through entity tax because they already have an unincorporated business tax, and Virginia doesn't yet have one of these. Other ways to reduce business income. So if you do receive a K-1 from a business, partnership, LLC, S corp that you that you work in, and those entities don't reimburse you for all of your business expenses related to that entity, then you can claim those on your personal return against your K-1 income. Retirement plan contributions related to your business income is always a good idea in general, but obviously from a tax savings perspective, the SEP is a very popular and simple plan to utilize. You can set a SEP up all the way up until the due date of your return on extensions and make the contribution. And that's generally up to 20% of the net business income. If you have employees, then it's not necessarily a great plan if they've been with you for a while, because then you have to cover them too. But for basically sole proprietors or businesses without employees, this is a good option. Home office deduction doesn't work for employees anymore because there's no more miscellaneous itemized deductions, but it works well as a deduction for sole proprietors. And obviously business mileage for your personal automobile. If you have to drive around for business, now that we're kind of getting out of COVID, that's more likely to happen. Make sure you keep track of that and a log of some kind, and you can take a mileage deduction on your personal return, unless the business is reimbursing you on a per cents per mile. But assuming they're not, you can take a mileage deduction. Other 2021 tax law changes is kind of a hodgepodge here of different things. The 2018 law suspended net operating loss carrybacks, and then COVID laws that came into place allowed you to do carrybacks for 18, 19, and 20. So now that original 2018 law that disallowed it to come back into play again for 21. So if you have an NOL for 21, you must carry it forward. And then when you utilize it, you can only utilize it up to 80% of the income on that return. So keep that in mind. Business meal expenses are now 100% deductible for 21 and 22. So this normally qualified business meals were only deductible at 50% of the expense. So now to incentivize people to go out to eat post-COVID, they have made that 100% deduction now. The third round of recovery rebate payments were sent out early this year. So that's something that will be reconciled on your 21 tax return, subject to AGI limits. So if you didn't get it and you're below the AGI limits listed here, 75 to 80,000 on a single return, 112 to 120 on a head of household, and 150 to 160 on a joint, then you can get that on the 21 return. If you got it and you shouldn't have gotten it, you don't have to pay it back. 2020 had like a 10K exclusion on unemployment compensation. That's not there for 21. And the dependent care credit has increased for 21. And most people won't get a $4,000 or $8,000 credit, $4,000 for one child, $8,000 for 2 or more children. But the credit is generally phased down to 20% for most of our clients. So you used to be a $600 and a $1,200 credit for most of our clients, and now it could be $1,600 or $3,200 in most cases. And the dependent FSA max used to be $5,000. It's $10,500 for 2021.
So we've come to our third polling question. Do you plan to take advantage of the new pass-through entity election? A, yes, it would save me a lot of federal tax. B, no, I do not have any pass-through entity income or do not see much benefit. C, not sure, I need to look into it. Please take a moment now to answer the poll. While participants are submitting their answers, I will provide the third and the final CPE word. The third CPE word is inflation. If you wish to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the third CPE word is inflation.
Thank you, everybody, for participating in the poll. Looks like a small amount. I think it would have helped them. And there's about a third of the folks that are not sure. So I'm happy to look into that for you. Just reach out and we can discuss it. If you find yourself in a situation this year where your income is down, or maybe you have a loss, not just down, but maybe you have a loss, may want to look to increase your income. So there's just a couple ways you could do that. You could do a Roth conversion. And I say why you still can, because there's, and the provisions I'll talk about could eliminate that for a lot of people. You could sell investments to create a capital gain. Then if you're over 59 and a half, you can always take money out of your qualified plan. So this is if you have a lot of itemized deductions this year and you're not going to use them all, or your income's down, or you have a business loss, and you could otherwise maybe not take advantage of all of those deductions or losses in the current year, and they don't carry over, then you would want to look to increase your income. Okay, so we have a few minutes left to cover some of these proposed tax changes. So the House recently passed a bill that's now, I guess, over in the Senate, and then the Senate will create its own version. They'll have to reconcile the differences. So there's a lot of work left to be done, but I'll try to cover quickly some of the key provisions. They're in the House bill. So the first one is the top ordinary tax rate is looked to be increased to 39.6, which was what it was before the 2018 law moved it down to 37. And they're also looking to have that come into play at a lower income level. So you can see 450 joint instead of 628, which is the current place where the highest rate kicks in. And then also 400K single versus 523, which is the current place. So you have an increase in rate and a lower tax bracket, kind of a double whammy on that if it goes through. Long-term capital gain rate, this has been talked about a bunch, a lot of different proposals that were put out there, but the one I guess that was settled on in the House was increasing the top rate from 20% to 25%. And if it does pass, it's effective for the sales as of the date of enactment. So if they passed it tomorrow, you couldn't then turn around and sell stocks between now and the end of the year and still get the 20% rate. You basically, there would be nothing you could do about that. You would, if you were in the highest bracket, you'd pay that 20%. So if you are pessimistic that this will, pass by the end of the year, then you may want to look to create some gains and pay the lower rate. They want to expand the net investment tax of 3.8% to apply to business income for people with over 400,000 of income at the single level or 500,000 on a joint return. So right now that 3.8% net investment tax only applies to passive business income on your return. If your AGI is above a certain level, I think it's 250K, but what the provision here is going to apply that to all business income, so active business income. So that's a significant change for those folks that are above the AGI limits. The bill has a provision to add a 3% surtax on returns with AGI above 5 million. Won't see a whole lot of that, but that is in place for the really high income earners. We talked about the qualified business income deduction earlier. So they're looking to cap that at a $400,000 deduction on a single return or a $500,000 deduction on a joint return. In order to get a $500,000, put this in perspective, in order to get a $500,000 deduction on your joint return for QBI, you'd have to have 2.5 million of qualified business income. So it's still a pretty generous deduction that most people will take advantage of, but they are looking to cap that. Next slide. The excess business loss we spoke about, currently that is only through 2026, tax year 2026, so they're looking to make that permanent. The SALT cap that Steve spoke about, and I mentioned earlier, related to the pass-through entity tax, is currently 10,000. They're looking to increase that to 80,000, but there's phase outs there. I think people over 400 and some thousand of income wouldn't get any of the additional tax deduction. So they are looking to increase it, and it would help a lot of folks. But for your really high earners, I think it would get phased out based on the current writing of the law. Wash sales, it generally just apply to stock sales or mutual fund sales at the moment, but they're looking to have that apply to commodities, currencies, and cryptocurrencies, which is basically you sell a stock at a loss and then rebuy it, and within 30 days of the sale, you can't take the loss. So that will apply to those other types of assets. There's a lot of tax credits in there for electric and green incentives, even for electric bicycles, believe it or not. And we'll get into that. But if you're looking to do any sort of solar or something like that, then that you could have benefits there if these get passed. Those increased child tax credits Steve spoke about, that's just a one, right now it's just for 2021. So they want to make those increased credits, advance payment, and increased FSA and the dependent care and all that stuff. They want to make those provisions all permanent. Right now, those are just a 2021 provision. A big deal here, one of the bigger items, is a change in the corporate tax rate. So they've created an 18% tax rate on the first 400,000 of taxable income on a C Corp. You're taxed at the current rate of 21%, from 400K to 5 million, and then over 5 million, you're taxed at a higher rate of 26.5. Also, personal service corps are taxed at the flat 26.5 they would be on all their income. And a lot of our clients that are C Corps are personal service corps. So this would affect them. Some gift and estate stuff. They want to move the current high levels of the gift and estate exemption, which is 11.6 million, back down to 2010 levels, which would be about 6 million per person. We'll jump over the other two because they're relatively obscure and running out of time. If you happen to, and the RMDs would be required for people who have IRAs and defined contribution plans of 10 million or more or 20 million or more. So that's, kind of a small subset of folks. But if you're in that place, you would be required to take money out of your plans. Next slide. So a big one is Roth conversions. You probably heard a lot about the closing down the backdoor Roth. So this is in the House bill. Basically, they want to disallow just general Roth conversions if you have income above 400K and 450K, whether you're single or joint. But that doesn't start till 2032. I don't know why that, they put that way out there. So that's just being able to do a Roth conversion at all. If there's income limits being put in. And then being able to, right now you can make some 401K plans allow you to make after-tax contributions to the plan once you've maximized your tax deferred contributions. And then you're able to convert those immediately to a Roth. That's one of the ways you can do a backdoor Roth. They want to eliminate that starting next year and eliminate the ability to make a non-deductible IRA and then immediately convert it to a Roth, which is a more common probably backdoor Roth conversion. They want to eliminate that also as of next year. There's also a couple things related to what you can hold in your IRA, investments that relate to accredited investor status and whether you own the entity itself, and we won't get into those things, they're more obscure. R&D expenses are currently deductible, but the way the law is currently written is you'd have to capitalize and amortize those starting next year, but they're looking to delay that capitalization and amortization requirement until 2026. So that's can be a big deal for some of our business clients. And I'll just stop there, and we're at 11:59. Steve, do you see any questions on there you want to take real quick, just so we address one or two before we end?
Yeah, one of them I went ahead and answered in the question and answer box, but it was the question just whether medical expenses, if health insurance would be included as a medical expense. And the answer is that it depends. If you're getting it pre-tax through your wages and your pay stub, then the deduction's already been taken for you. So if you're paying for medical expense out of pocket, then yeah, you would or if you're paying for insurance out of pocket, then yeah, it would be includable as a medical expense. Troy, one of the questions was, can you suggest a rule of thumb to avoiding AMT? And my thinking on that was most people don't fall into the AMT unless they have some kind of incentive stock options right now, but it's potential if they do pass the $80,000 SALT tax limit that you were alluding to and the potential changes, that you could see more people falling into the AMT again. Do you have any thoughts on that? Or
Yeah, that certainly would be the more state and local taxes, since that's an add back. Definitely, once you could, if you could take 80,000, that kind of an add back could kick you back into AMT. But yeah, as you said, right now, without miscellaneous itemized deductions on Schedule A and with the cap on state and local, very few folks are getting into AMT.
Yeah, anymore. But we did have a question on backdoor Roth conversions, but I think you kind of answered that.
So still in play this year, but it looks like if this law goes through the way it's currently written, that will be eliminated starting next year.
Yeah, those were the main questions that came through. There was also a comment about you can charitable giving for those over 72 and the required minimum distribution to give just directly a qualified charitable distribution through your retirement plan. That is a great tax strategy that I didn't mention. But besides that, there weren't too many other questions, Troy.
Okay. Sounds good. Thanks, Steve. Okay, well, thank you everyone for joining us. And I know I ran through a lot of the stuff I talked about really quickly. So if you have any questions, just please reach out.